Fiscal cliff talks are at a standstill as House Republicans prepare to vote on what's called Plan B, a measure that would raise taxes on those Americans making over $1 million a year. Stephen Entin is a senior fellow at the Tax Foundation, and he joins us now from our Washington bureau. Mr. Entin, welcome to Bottom Line. Thank you for coming on today.
Thank you.
Sir, President Obama says that if Plan B does reach his desk, he will veto it. What are the pros and cons of Plan B? Is it balanced?
Plan B would extend most of the expiring tax cuts and avoid the so-called fiscal cliff for almost everyone. It does raise taxes on people with adjusted gross income over $1 million. It would increase the capital gains rate and the dividend rate from 15% to 20% for those individuals, and their top tax rate to 39.6. I think it's balanced in the sense that if you raise taxes on capital formation, you're going to depress investment and productivity and wages, and it spills over to everyone. So the less you raise taxes, the more wages stay higher than they otherwise would.
Yeah.
You can't say that this particular plan only affects the millionaires. It affects the economy, which affects employment and wages adversely.
Sir, the IRS estimates that as many as 100 million taxpayers won't be able to file their forms until late March if Congress doesn't adjust the alternative minimum tax, the AMT, by the end of the year. The AMT adjustment is part of the fiscal cliff negotiations. If the AMT isn't fixed, what type of hit are taxpayers looking at?
Well, a pretty substantial one. You'd have about an additional 20 million people having to pay the extra tax that the AMT imposes. The IRS has a problem every year when Congress waits for the last minute and it has to get the forms out, and they just don't know what to put down. The AMT was not indexed for inflation, so for the past several years, Congress has had to keep increasing the exempt amount under the tax to keep pace with prices, and if they don't, it reverts to a very low level. Instead of almost $75,000 for a married couple, would fall to $45,000. This is an awfully big hit, and I don't believe they're ever going to allow something like that to happen.
Mr. Entin,
it's really quite unusual to have two tax systems.
Well, sir, you correctly pointed out it was never adjusted for inflation when it was introduced, I believe, back in 1969. Why not? And wouldn't doing so give middle-class, middle-income families the certainty they need when planning their household finances?
It wasn't done because they wanted to have a big number for the budget forecast to make things look better than they were. The answer to your other question is yes, of course. There's no point in keeping people guessing like this.
Well, mortgage relief could also be affected in the fiscal cliff talks. The Mortgage Forgiveness Debt Relief Act of 2007 expires in less than 2 weeks. If that program isn't extended, some homeowners could get a very nasty surprise in the form of an extra tax bill. How big might those bills be, especially for homeowners who are still struggling at this point?
I'm not an expert on that particular act, so I can't answer your question. I think, in general, we need to get the government to back itself out of the housing market about as far and as fast as we can do. It was responsible in large measure for the initial bubble, and it was responsible in large measure for the subsequent collapse and distress. I think if you're responsible for a problem, you shouldn't be looked to be the one to fix it. You should just get out of the way and let the markets clear and let the real estate sector get back to business as usual.
Yeah. Mr. Entin, if you're an American company and you park your money offshore, you only pay taxes if you bring that money back to the U.S. Deirdre Cummings is the Legislative Director for Public Interest Watchdog Foundation, MASSPIRG, and she writes that the $150 billion lost to tax havens would be more than enough to cover the automatic cuts to public programs if a fiscal cliff deal isn't reached. Are you surprised that this question of offshore tax havens hasn't been discussed or more closely looked at this point?
No, I'm surprised that someone is making the claim that they aren't taxed. These companies have paid tax to the foreign country in which they have earned the income. This business about not repatriating money. If you repatriate it, you end up paying an additional tax to the U.S. government over and above what you have paid the foreign government if our tax rates are higher than their tax rates. Our almost unique in the world pattern of saying we're going to tax our domestic companies on their global income, which almost no other country does, just simply makes them park their money offshore. There's no point in bringing it home. So they borrow to invest here when they have cash abroad, and they use that cash abroad to invest overseas. If you want them to straighten out their balance sheets and have a more sensible pattern of investment in the world, get rid of this double taxation. The French don't tax French companies' earnings in Germany. They leave that to the Germans and vice versa. We're the only ones, only major country that does this nonsense. It is taxed abroad, and it is not escaping tax.
And, sir, do you think maybe then it's time to revisit this moratorium on that as we did in the mid-2000s?
A one-time holiday would bring in some revenue if you let them bring it back at a reasonable tax rate. But the real solution to this is to stop taxing global income. Let the income be taxed where it's sourced and not try to have a global tax system. Again, we're about the only major country that does this. Other countries that have switched to what's called the territorial system have found that, if anything, their economies have improved.
All right, Stephen Entin, he's a senior fellow at the Tax Foundation, joining us from Washington. Mr. Entin, thank you so much for your perspective and your time today. We appreciate it.